What's up, everybody? What's going on to the Outliers? Happy Friday. It looks like we have some mixed reviews in the chat on how the week. Whoa, don't. Some audio feedback. We're good. We're back at it. All right, first, let's get me out of the way and let me grab that chat again because I want to say hello to you guys. And also, it looks like there's a handful of stuff you guys were covering. So we got Tom, Paulo, Greg. Good to see all of you. Looks like Paulo's saying that he had a bit of a drawdown. Same thing with Tom. That's actually interesting. I, too, much like Greg, am curious what happened here. Paulo says, unbalanced butterfly on Tesla went all the way south. Yeah. I think if we look at Tesla, that's a tough bid for a butterfly. That's kind of dramatic. I guess it depends on how the butterfly was structured, but really has been pretty range bound. I'm surprised to see that your butterfly struggled, to be honest, because this doesn't look like not much really happened this week. There was a really interesting post on Reddit. Let me see if I can find it really quick. That it continues to highlight to me how skewed traders are with their perception and understanding of markets. And I want to see if I can find. Yeah, so yesterday there was a post here. Let's just look through them together really quick. There was a few posts in here that I thought were topical. So the first one that I see is this, where it says, you know, today, this was a day ago, yesterday. Today was a beautiful day to get steamrolled. That's not great. We'll talk about that in a minute, why I think that that's kind of silly. And then there was another one that I saw. Look, what are some easy hedges to put on? Again, like this, I talk to you guys about this all the time because it is a disease. If you start letting this take hold of you, your ability to take logical risk as a trader starts to go away in a significant manner. So I say that because as I look across most traders in these kind of subreddits, most of them are trying to grow their accounts. If you are too concerned about risk, you are going to have a hell of a time trying to grow your account. And what I mean by that is if you try to hedge away all of your risk or even too much of your risk, we do not have wide enough margins to be able to reasonably run that. So I see this, again, this is just somebody who doesn't have a good relationship with risk. And I see this as somebody who struggles to take good risk. This is another one that stuck out to me. Lost 50% of my gains for the year. And there was another one, this one. What did we learn today? So this is, again, was yesterday. And this person says, and notice where this is all from, Theta Gang. All of the Theta Gangers are starting to flip their lids because the market moved 1%. What does it tell you? It tells you a bunch of things. It tells you that the majority of these people that are trading these strategies are not used to being challenged in any meaningful way if a 1% move in the market unsettles you. A 1% move in a market is standard fare. Sure, maybe slightly more volatile, you know, context dependent on what time frame we're referencing. But writ large, a 1% move is a joke. And if we look at how the S&P 500 moved this week in general, I'll get this out of the way and we can grab some SPX. This is what it did. It opened here at 52.57 and it closed at 52.04. Like we're not seeing any. It's a percent. We moved a percent. So when I see traders freaking out like this about quite literally this part on the chart that you're looking at here, that means we have a big problem. We have a massive problem in what we're doing if this messes you up. So it's a great learning exercise, though. This past week, is a fantastic opportunity to look through what you're doing. How did it perform? How did you think it was going to perform? What risk did you think was going to behave a certain way, but then actually move slightly differently? So there's a lot of really great reflection that can be done in this kind of week, because again, we haven't even seen down weeks for a long time again. So I just encourage everybody to take a look at what you did this past week. And if it made you feel any type of way under the surface, there's a problem. That's what it tells me. To what degree that problem exists, I don't know. It obviously is context dependent, but this kind of market movement in a nutshell should not bother you quite literally whatsoever. That's that. We also got Mike in the house. Mike, good to see you. Greg says, I traded one DTE NASDAQ options. I kept going directional and Gamma would rip my face off. Then Gamma would save my ass. Maybe 25% stop loss is the answer, or stop doing one-sided directional trades. Well, a couple things. Gamma did nothing to you. Gamma just measures things. But more importantly, if you're trading one-day futures and the market's moving, I don't really know what else you would expect. That's kind of how markets move. So again, even if we look at NASDAQ, realistically yesterday specifically was very persistent direction. The few days ahead of that still were pretty persistent direction. And what I'm using to assess that is kind of how big the candles are and if there's big extensions on both sides. We're not really seeing that. So yeah, to me, I mean, there's probably a bunch of different answers. I think a 25% stop loss by all accounts is not the answer. Trying to apply a very simple overarching tool like that can help, right? So if that would keep you in the game and that would keep things moving, I think that's okay. But just acknowledge, it's important to acknowledge the fact that that's not optimal in any way, right? Just think about how easy that would be in trading. And essentially, if all we did was take a directional position, take a 25% stop, and then over the long run, we would make money doing that, right? And I'm not poking any direct fun or anything. It's just to highlight that point that if we want to simplify our rules so much, you're going to get simplified results. And unlike investing, where simplified is actually much better, in trading, it's way more nuanced. A lot of the money that we make in trading is in the gray area. And I mean, I have a bunch of examples from this past week with zero DTE. I was trading zero DTE options yesterday, and very much I started to get ran over. I ended up making like 60 plus transactions in SPX, and I still walked out slightly negative, but my loss originally was much larger. And my only job for the rest of those trades was to pare down that loss. I wasn't necessarily trying to turn it positive. It didn't matter to me so much. What really mattered was getting the trade to a healthier spot. And it was mostly through rebalancing and just continuing to transact around where the price was moving. But just when I see stuff like Gamma would rip my face off and then save my ass, again, I've learned to like read into the language that we use, and it's just emotionally charged. I can tell that probably throughout those transactions, there was a lot of emotion, whether it's subconscious or not. Even if we describe it that way, rip my face off, save my ass, and I know part of it is in jest, but still the fact that we would frame it that way is telling to me as enough. So yeah, and Greg says, true normal movement, I needed to prepare or plan my adjustments or exit in advance. Now, perfect. That right there is exactly the kind of analysis that I hope to help you guys with. And that's the kind of stuff that I hope most people start to pick up, because I completely agree with you, Greg, especially that actually connects those dots, right? How I was just saying, I sense an emotional cycle. Well, that makes it totally clear to me. If we didn't have like a clear plan into the trade, naturally, for anybody, that would be an emotional cycle. So yeah, I think you hit the nail directly on the head with that. There's nothing wrong with trading directionally. The problem is that a lot of people, our egos get disrupted, because if you're trading directionally well, you're still going to be wrong a lot. If you're a good directional trader, you'll find that you lose all the time. But that's what makes you a good directional trader, because we're doing our best to be wrong quickly with small losses, so that when we get runners and things move in our favor, we're able to appreciate. And I actually think I have a couple recent examples of this. I told you guys before that I was trading Tesla. This was a little while ago. And I ended up getting out for kind of a scratch. I actually think it was a small profit. I don't totally remember, but I just remember when I was getting in, I didn't want it to keep going down. That I knew. And it started to contract down. It wasn't doing what I wanted. And as soon as I saw just a slight bit of accommodation, I took my exit because my directional disposition wasn't working as I wanted. I was actually recently just talking with the Outlier Pro members, and I'm actually going to provide a more in-depth update to them on this trade. We literally were just talking about this past weekend. I literally was walking through the trade that I have, how I transacted, and actually, funny enough, how this one wasn't doing what I wanted it to do. Well, obviously I need to shut my mouth because I had obviously a fantastic week in Newmont, and this is a directional trade, but I was fully prepared to get out of this because it wasn't doing what I wanted. But after we had this kind of coil phase, we started to break up and out, and that led to what we're seeing here, just a nice big rally. And this can go either way at any time. I'm not saying this is some sort of example of, I'm so good at picking stocks. I'm not. This was just something that wasn't working that started to work. And now all I'm doing is managing around the trade. You can see that I've slid my stop up right up to kind of the end of this candle. And I'll continue just to follow along with this. But this is another prime example of something that I was trading directionally, wasn't doing what I wanted. But the whole time, it doesn't scare me out of it. I have a very clear plan from the onset of the trade. What do I think this is going to do, in what time frame, to what magnitude? If you're not making those steps as an options trader, you have a giant gap in your process. And I find, especially as I talk to like different people that I coach now and those kinds of things, I find people, interestingly enough, are trading products called options that have expirations. But when we're making our thesis, we're not defining the time frame. Think about the disconnect that's happening there. We're just making a general thesis. We're trading a product that undoubtedly expires, yet we're not comfortable making a time constraint on our thesis. Again, not to become your online psychologist. It's not the role that I want to fill. I view the psychological component of trading as kind of a feeder for being able to do the rest of the cool shit we do. But I also don't think we can neglect it. And this is, again, just a primary example of human psychology at work, because we're too concerned about being wrong to time-bound an estimate. You're automatically doing it by trading an option, but by not kind of acknowledging it up front, well, now you're not necessarily accountable for if you get your move, but it wasn't fast enough. You'll see that all the time, especially if you take, any tour around Twitter. You'll find people pontificating about all sorts of shit. And I'll tell you what, man, if you beat the drum long enough, somebody's going to fucking dance. And it happens all the time where somebody says the same thing, the wrong time and again. And then once in a while, they're right. And that's obviously what they're going to hang on. That doesn't work well in trading. I think that that's typically a pretty problematic approach because there's an opportunity cost to our money. Now, again, as you guys know, when I talk about this stuff, I'm talking about it from my perspective. This is not the only way to trade. There are people who built entire trading careers around trading things like pivots. That's a thing. People who trade pivots tend to have really low win rates, small losses, low win rate, high loss rate is what I was trying to get out there. But their wins are massive. And that's a style of trading that can work for them. So I just want to be clear, as I'm talking about these things, I never want, especially you guys in the community, to think of me as the way to do things. I'm not the way. I am a way. So as we discuss these different things, just keep that in the back of your mind, that if you hear something like that, oh, well, I like trading pivots. That's okay. You just have to have a good system to trade pivots. For me, it's a really tough way to make money, especially consistently, which again, that all feeds back into what my motivations are as a trader, what I prioritize as a trader, all those kinds of things. I want to make that note just because I think it can become easy to get sucked into a unilateral way to approach markets. And I actually think that's kind of not good for anybody. It's also why you'll see me talk to people all the time, like Ewan Sinclair, and he's not that big into some of the things that I'll do, like buying options for leverage, because I'm more or less buying options that we know are going to be marginally overpriced. But again, in that scenario, like, I don't care. I don't care if it's slightly overpriced. I'll pay a premium for something if the directional move compensates me for it and it makes me money because I'm good enough at picking direction, at least marginally, so that it ends up paying out. Same thing with somebody like Tom Sosnoff. I interview him pretty regularly as well, and he typically will take a counter side of the trade. That's his go-to. He is a premium seller. It's because he's a market maker. We actually talked about this a bit in our last podcast. And it's really fascinating to me, actually, to understand like the basis of his contrarian perspective. He doesn't do the contrarian thing necessarily because he thinks everything is like so grossly overextended, and he's just so used to being on the other side of trades. It's his default. And again, like, he's made a business around it, obviously. So just as you hear different people talk about different styles of trading, it's great. It's actually a really important thing to do. It's why I host the podcast. I get to learn from people like Matt Cruz. So I mention him all the time because he's another really interesting trader that does things very differently than me, but he finds success doing what he does. He likes to trade more small cap breakout style stuff. And that's an efficacious strategy as well. Again, the difference is he'll have really big up years. I typically don't. I had my first triple digit up year last year. It's my only one. All of my other up years have been double digits at best. I think the highest before that was like 52%. Great year, no doubt, but not what some of these guys are doing from like the US Investing Championship where they're getting 300%. That's really massive. I haven't done that. But the big difference between what they do and what I do is I'm a steady motherfucking drumbeat. Like, I know without a doubt at this point on an annual basis what I'm going to return. I know. I've done this long enough and I've isolated things well enough so that I have a very low variance in my return rate, which is something that I personally prioritize. It gives me a lot of confidence to do what I do in all different kinds of market conditions. And more importantly, it feeds my broader objectives. So I think all of that is just important context for folks, you know, as you guys hear some of the different ways that I approach things. Why not says I stood on the sidelines this week. Yeah, that's okay too. I honestly, I limit that as much as humanly possible. You guys definitely would have remembered during COVID, there absolutely were periods where I wasn't doing anything as well. So if you feel uncomfortable or if you need to take a peek at, you know, what's going on before you decide what's the best strategy, there's absolutely nothing wrong with doing that. One of the things that I've learned in trading is that genuinely sometimes going slower equals going faster. And I've talked about this before. And to kind of hit the point home, I'm going to show you the same thing that you've seen a million times, but it's worth discussing. Is you can have a portfolio that has a lower average return, but a better compound annual growth rate. So the reason why I bring that up is because by going slower, you can go faster. So in Why Not's case, rather than putting a bunch of trades out there to try to just keep trading and starting to increase drawdown, if you maintain a solid, steady return, you can have a really efficacious long-term run return. So yeah, I see absolutely nothing wrong with doing that. Now, it's got to be constrained because I'll tell you what, that comfort of being on the sidelines and watching can become kind of addictive because you feel just so relaxed because nothing's going on. And I've already told you guys I have some travel coming up in the next few months, and I'm adjusting my portfolio so that when I am traveling, there's nothing that would burn the house down while I'm gone. However, I'm not going to take all risk off. And it's for the same thing. I generally think that keeping some sort of risk on most times is probably the way to go. Mike says slow is smooth, smooth is fast. That's exactly it. Slow compounds. That's what I think about. In a trading perspective, If you slow down, you can compound. And as things compound, it gains significant velocity that starts to matter. And again, that's actually why I built these different tools for you guys, because I think that they're really useful for this context. But if we have something like a $25,000 account, let's say that you're in the process of adding $500 a month, you're being a good saver, you're going to give yourself 20 years. Let's say that you're doing well as a trader, you start to figure it out, so you're returning at least 12%, and then I'll add a 2% variance. I want you to look at something. If you look at the underside variance, if you hit your 12%, maybe sometimes you run a little above 13%, 14%, but let's just call it you keep hitting that 12%. The future value of that is $673,000, just in this quick example. But at 2% lower, your 673 is actually 511. So again, if you're chasing this 12%, but instead of 12, you get 10, you essentially are killing your returns by $250,000, almost $200,000, something like that. So the point I'm making is sometimes going slower, having more consistent returns can actually do better in the long run. But again, this will come down to the trader. Sometimes if you are a streaky trader, that you can have a slight down year, you're down 6%, but then you have a great year up 400%, the math still checks out, you're fine. So it really comes down to your return profile as a trader. Let me see. Nini, good to see you as well. Tom says it was just the weeklies, didn't have time for the trades to work out with the movement this week, so got stopped out on some trades. And that's okay. That's kind of to be expected. As I already talked about with SPX yesterday, I got all sorts of chopped up. And I had to transact a lot, way more than I want to on an individual daily basis to get it back to a healthy spot. So I think that's okay. But let's take a look at, so I already told you, and you guys can already see, the S&P 500 did have a down week. It's down about 1% and change on the week. If we take a look at the NASDAQ had a slightly better week, but not by much. And you'll notice that the volatility in the NASDAQ yesterday was slightly elevated. This matters because as I think about, again, there's nothing novel about what I'm walking through with you guys. And in this case, if we look at the 5-day performance here, you can see that communication services continues to be relatively strong in the more recent timeframes, but IT is starting to drag way more than it typically does. So that's actually an important thread to keep in mind. Joe says IWM down 3.7%. I actually haven't done the math on IWM yet, but that absolutely sounds right. Let me get rid of this alert for now so it's easier to see. And then I need to add this alert. So there's kind of a series of alerts that I'm setting for different things that I'm trading in different ways. And this is one of them. I was actually outlining again to the pro community in the Discord some of the recent movements I'm making in IWM. And a lot of it is just repositioning and resensitizing my basis. So as I looked across my position, I had a really good aggregate basis, but we've been trending sideways for some time, and I've been scaling into IWM for a long time now. So what I ended up doing was actually flattening a lot of the position and then buying more of it, but at a set basis. And this isn't good for taxes. I wouldn't recommend it for that. But from an options trading perspective, it actually kind of protects me a little bit because I don't have to mess with as much of the accounting, whether I'm using FIFO or LIFO, if I have a more standardized basis. Because previously I had a lot of unrealized gains that I ended up holding for over a year. So those are clear to come off at long-term capital gains. There was no reason to take them off before that, especially because the product was doing that I wanted. Now, something that I mentioned to you guys is I never would allow taxes to be the defining feature of what I do in trading. But if everything else is taken care of, there's nothing wrong with integrating taxes. Greg says, what do you mean by sensitized? Yeah, so I call it spot price sensitivity. And you'll find this in a bunch of different ways. But essentially with IWM, I had started accumulating a position from way back during COVID. And I still had long shares with like a sub 100 basis. And then I scale in all the way up to here, all the way up into like the 230s. And then as it comes down, I scale in on the way down. And all during this time, I'm trading the covered strangle, which includes instances where the short calls will get called away. So what that means is I have to be very careful about what shares are being earmarked to go out the door. So if I'm trading things that are LIFO, last in, first out, it means that I'm going to be trading this more recent basis that I actually probably don't want because I'm unwinding that position unnecessarily at a massive loss. Or if I do FIFO, first in, first out, it means I'm using the basis from down here, which is fine, but then it's going to move up my aggregate basis so that subsequent sales in the covered strangle or whatever else I'm trading, now my average basis, instead of being in the 100s, it's now going to be in the 2s, maybe even almost mid 2s if we had an extreme example where I was getting, too centralized here. So by unwinding and then resetting my basis, it essentially means that the vast majority of my position basis will now be in the 204s, well, 201 to 204 for the recent purchases. I still have some legacy positions on, so it's not quite that simple, but I'm trading now LIFO for those positions, and I'm making sure that I'm not unwinding IWM shares that I got for 230 for short calls that I'm selling at 206 that otherwise are above my average cost basis, but the shares that would actually move would not be. So it's just important, especially with more thematic positions like this that are built over time, to pay attention to some of those more subtle details. But Greg, that's what I mean by kind of the sensitization. Shreya says, how do you manage a short call that goes rapidly in the money when trading a ratio called diagonal? I mean, same. I don't think there's anything unique about that. I am so stupid. I literally was trying to type in VLO, which Shreya, just gave me the ticker, so I wanted to look at it, but he said ratio called diagonal. And the Cro-Magnon part of my brain typed in RCD instead of VLO, which, funny enough, actually, this used to be a thing, I suppose. Does Invesco exchange traded S&P 500 something? This is something. That's kind of fun. But we're going for VLO. Yeah. So this is something else I have a position in. I've already talked to you guys about this. This is just trend following at this point. So the tenets of, again, in the money short calls and managing that in a ratio called diagonal, as always comes down to what you're trying to do with the portfolio. How do you feel about inventory? And then what do you think about the underlying that you're trying to trade? So for something like this, I'm in the process of trying to maximize profit. That is the overarching goal that or the overarching paradigm I'm applying to this. So it simplifies what I'm doing quite a lot because I just analyze what movements make me the most money. That's it. Now, the other thing that you kind of have to remember, though, that if you have short calls that fall in the money and you have some sort of longs covering it, whether it's shares or if it's a ratio called diagonal, whatever it is, you do have to be sensitive to the fact that you're kind of in not a bad spot, but not a great spot. Because if you want to realize your profits early, you're going to pay more than you should to close the shorts. It's one of the reasons why when I'm selling things like ratio call diagonals and covered strangle short calls against the shares, I try to do it closer in time so that you don't have this scenario where you have something that skyrockets up above like this, which is exactly what I wanted it to do. And then because I have to wait 3 months for my short calls to decay enough for me to be able to get out of them without paying an excessive amount of extrinsic value, it could come back down. And then you're like, well, shit, this whole time I'm in the process of trying to wait to get as much extrinsic value out of the options. And even if they're really deep in the money, as the underlying inevitably comes back down, that actually adds more and more extrinsic value into your options as it becomes at the money or even slightly out of the money. So that has to be part of your management plan with stuff like this. But for me, it's actually, yeah, really simple. There's nothing novel about whether it goes up above the shorts fast or slow, because I'm mostly going to take care of that by selecting expirations that make sense. If you don't do that, that scenario that I just outlined can happen, and you can get stuck in kind of a shitty spot where you have a decent profit, but not great profit liquidity. That's not what we're trying to accomplish out here. That's bad news. Yeah, good question though. All right. This was another thing that I came across that I wanted to talk to you guys about that I thought was actually really interesting, because this is almost like fool me once, shame on you, fool me twice, shame on me. And there was a kind of a earthquake in Taiwan, and it didn't impact really any significant sections of the chip sector. However, it does start to beg the question again of what are we doing here? And what I mean by that is we're still not in a place yet where we're making good alternatives for chips. We're trying to domesticate some of it. We're working on it, but we're not quite there yet. So what that means is if there was a big issue in Taiwan that, did impact the chip sector, it's almost like exactly what happened during COVID happens again, where we had all kinds of supply chain disruptions during COVID because of COVID. And then we realized like, shit, we're way too dependent on a bunch of things. This is why the automotive industry got so lagged behind. They couldn't get the vehicles put together because of breakdown from integration of technology from things like chip factories. And the earthquake was just kind of a reminder of that. It's like, wait a minute, for semiconductors in general, like we still are very focused and centralized in this one area, which is something that it's a risk. That's the way I look at it. It is absolutely a risk. And it's also a good reminder that no matter how much, technical analysis you do and how many lines you draw on a chart, if a fucking earthquake happens, that's going to impact your stock. Even if it's having this really beautiful consolidation and it just did a cup with handle and we think it should be flying off to the moon because it had great revenue growth. And then a natural disaster can occur and derail all of that. This is part of what makes me maybe a little bit too risk averse as a trader, but it is something I think about in trying to really manage risk full stop, which includes both systematic and unsystematic risk. This is the kind of thing that I think traders can forget about sometimes when we're too concerned with, whatever our latest thesis is on something. That can actually get kind of dangerous. And so this is just a reminder for you guys that, believe it or not, Mother Nature still has a big say in what happens in your portfolio. And don't forget that. That's part of what we do. So thought that was interesting. Wanted to talk with you guys about it. Now, this one. Joe says Mother Nature always wins. Mother Nature is unfucking defeated. My man. Yeah, I literally couldn't agree more with you. Mother Nature is one of those things that, especially as humans, I feel like sometimes we get too comfortable and we forget just how big of a role she has in things. And every once in a while, she goes out of her way to remind us, and rightfully so. We should be reminded. I want to show you guys this next. Paulo says, was TSMC stock effective? Well, we could take a look, but not really. Interesting. All right. Oh, TSM does. So I just realized Big A says it's TSM. Yeah, I was just like, TSMC, what's TSMC? But no, I mean, for TSM, there really no real impact here. And it's still going strong. Actually, fun fact, for one of my preferred breakout strategies, this is starting to get there. So we had a big strong earnings. We had a big up move. So this is from 112 to 158. And now we've been channeling sideways. So this is actually a pretty solid setup for a breakout. I typically would use some sort of breakout over a near-term reference period high, not the actual high. It's up to you though. You can use something like that if you're so inclined. But for stuff like this, what I'll actually do is set whatever the previous high was after the decline. So something like this, I would set an alert to see if we can get movement up above that. And if we do, which I suspect we will, that starts to become a bit of a breakout play, especially if we can challenge these near-term highs. But this becomes like an early entry signal for me. So this is something that I will keep an eye on, but it is still too early for me, at least. But it's like this is kind of breakout stuff 101. I just realized I clicked in that spot like 3 times. That was a little excessive, wasn't it? Dan says live cattle futures with big dip from the bird flu, time stock up on 6. Yeah, which is funny because I was actually just talking with a buddy about that on a chat earlier today. And he was saying that he thinks that he might be sick with the vid. And we were talking about this. I saw a New York Times article that was talking about how the bird flu could be like really bad and all that kind of shit. And I actually, I was just like, okay, well, that's something to be aware of. I didn't start digging too much into it. And then I was looking at I was talking with him about it, and he was saying, we looked up a couple articles together, and it looks like it hasn't even like crossed over to people yet. But New York Times doing a solid job getting out there fear mongering. I thought that was pretty hilarious once I looked it up, and I was just like, oh, I see. I understand now, because you guys are just being super dramatic and it's actually not necessarily a big problem yet. Hilarious, isn't it? But news agencies got a news agent, I suppose. The other question I have for you guys is, we obviously are kicking off our next quarter. And if you didn't know that, news alert, we are kicking off the next quarter. We wrapped up the first quarter of the year. So far, what's the trading performance been like for you guys? What I really want to know is if you guys are trending in line with expectations, or if for whatever reason we're not. And if not, I would like to know why you think that is. This is something I have, again, a lot of the pro members actually working through, specifically like on the coaching side, is just doing a post-mortem. But I think that it is still important for everybody to think about this kind of stuff. And for the pro folks in the Patreon shop, which you guys have free access to, there's a template that walks through kind of like a very simplified analysis that you could do on a monthly basis. But for those that don't have access there, it's no big deal. You can make your own. Essentially, we're looking at what was profitability, what did our reference benchmark do, whatever you compare yourself against. The S&P 500 SPY is very common. What was the max drawdown and the max high? So kind of the extremes of the portfolio, number of trades, number of winners, losses, commissions, then looking at individual strategies, average hold time, stuff like that. So the reason why I think it's really important to do that is because, especially with a year like this, I was in the process of doing an analysis that's not done yet, but I do want to share it with you guys at some point, where I'm analyzing how the stock market tends to perform in the second half of the year, when the first half of the year is up over different percentages. So up over 5%, up over 8%. And then I haven't gotten it down to the quarter level yet, but I'm also curious about that. You have to be kind of, skeptical of those kind of statistics. There's not really too much that I think is very tradable there, but I do think that it is at least worth looking at. Joe says sell in May, go away, then Christmas rally. Yeah, there's way more than that. And there are market effects like that that are tradable. There's no doubt, but you have to apply a practical approach to it. So it's obviously not quite as simple as that. But yeah, I mean, there are a ton of those kinds of things. There's a few really good books that analyze a lot of these kind of market phenomenon like that. But it's definitely a thing. Tom says he's above target so far. That's good. Yeah. So when we think about the rest of the year, there's a couple things that I implore you to keep in mind. The first one is that we are still working with a insanely Fed heavy market. And what I'm doing right now is logging into Fred because I want to show you a couple summary statistics just about how right now we're doing as a general group of people. So specific to consumer strength, and then looking at some broader banking metrics. So here's a simple one that we can look at together. And for those that don't know, this is actually like a really cool feature with Fred is you literally can make your own little dashboards like this. So actually this is something that I can create like a quick tutorial on sometime in case you don't know this, but it's like, I don't know, it's just a really easy way to see a lot of great data. The only downside is you have to be really careful with the scales because a lot of them are a little dramatic. So like this one, I typically have to click into. I don't really care about, delinquent auto loans from the 50s. And if you see something like this that only goes up, in this case, it's only loading up to 65, it just means that the data source is not active on it. So you have to pay attention to the different sources. But so like this is interesting. People talking about, the consumer perspective and how awful things are. But if you look at it in terms of mortgages, not a big problem. If you take a look at credit card loans, not great. So personal savings rate, also not great. Consumer loans, overall loan amounts going up. So these kinds of things, actually, they don't always move in line with one another, right? So people aren't defaulting on their houses, but they are racking up credit cards. So stuff like this starts to become more uniform as the problem gets worse. So right now, I don't see a massive problem here. I do see auto sales. This is kind of, I think they have another one actually, which is like a repossession one. If not, you can, let me see if I can find it. I think you can get that one from Y Charts. Nope, that's not it. Here we go. So this is just looking at auto loan delinquency. So it's not quite repossessions outright, but it's essentially saying these are the, vehicles that would be eligible for repossession. So this is starting to uptick. So all this says, this is again, not designed to spread fear. This is just designed to say that the consumer is starting to get squeezed to some degree. To what exact degree, we don't know yet. We're not seeing mortgage defaults, which for those that don't know, this tends to be a little bit later in the problem. If you think about it from the normal consumer perspective, typically credit card usage will go up, then delinquencies will go up, then auto repossessions or auto delinquencies will go up. Mortgages tend to be towards the end of where we see a spike because most people are more concerned, rightfully so, about their house. But savings rate is generally one of the first ones to tank. So when I just look at the consumer picture, again, I'm not an economist. I don't pretend to be, and I don't really spend too much of my time going through this stuff trying to create intricate links. I just try to keep it from a very superficial level based on how the consumer is positioned right now. How does that potentially impact the market? So I think it's still a little too early because consumers are still spending, is what it comes down to. The credit amount is not going down yet, which is honestly not great, but we're not at a point where we're seeing catastrophic problems. I would absolutely keep an eye on credit card loan delinquencies. And then I absolutely, Joe says more data on the top middle chart. What do you mean more data? You mean like more? I'm confused. Could you explain what you're asking, Joe? You mean just it's less than a year? Oh, I see. Yeah. If you want longer run rates, you can absolutely, again, adjust any of these. It doesn't really matter though, for the conversation, at least that I'm outlining. And well, you know, it's a federal thing, so it could take a minute. I'll give it another second. There's probably some dude in the back trying to spool this up. Okay, there it goes. Let me see if I can just change the time frame. So here we can go back 5 years. And I think this is probably enough. Big A says, if the reverse repo continues depleting at its rate to 0, will that incentivize them raising the rates? It could, but I think they have other tools in the toolkit before they get to that. It's not quite as linear. I also think the repo market will normalize a little bit. I don't think that the rate will go to 0 before an adjustment in the repo market. Joe says, I like to see previous recessions data. Yeah, there you go. It's the downside to using, like, you can even see, like, using previous recession, it's still, even when we weren't in a recession, it absolutely is skyrocketing. Joe says, can bottom be set to 0? Joe, you can open the fucking chart for yourself, because I think you got what you need. I already clicked in, you see a longer run rate. Really what this comes down to though is consumers use credit, right? Increasingly so. But we're getting to a point where the spike in usage is getting slightly extreme. And again, we can see that starting to bleed through in other spots like this. And again, this is for the past year. You can go to 3 years, but this kind of spike on a percentage basis still isn't crazy. So if you look at this, this is 4.17. And at this trough over here was 3.73. So it's still not exactly going super crazy. Joe says only like 10% increase, but makes it look like 200%. Yeah, I mean, if you're not familiar with interpreting charts, I can absolutely see that. And it's a good point though. And I am glad you bring that up, because especially for things that aren't log scale, I think in general, having charts that are log scale for stuff like this is my preferred, but it's less accepted. So it does kind of do exactly what you're talking about, Joe, where it can like really skew your perception of what you're seeing. And I totally agree with that. But it's less about the severity of the increase and it's more about the trends, in my opinion. I think that's what matters. All right. Well, that's Fred, in case you guys don't know about Fred. Now you do. What else we got? There's a couple of things I want to talk about. Actually, we already talked a little bit about inflation. We talked some about the portfolio rotation. You can see what I was talking about there, where right now I'm in the process of kind of repositioning things. I always start to do that stuff really, really early so that I'm not in any sort of bad spot. And speaking of spot, as you could tell, this one I actually wrote with the mouse. I can show you how I did it. It was like oh, okay, that's a little bit down. Do it for real. S T O T. Look at me go. That's pretty good. But anyways, That's the one I wrote with the mouse in case you couldn't tell. But they just hit a new 52-week high. So they look very interesting. They're flying off a handle. I ended up looking at it for a trade when it actually broke above this level. But again, because I'm in the process of positioning things as I am, I didn't enter. But this is absolutely something in any other circumstance I would have. But alas, timing wasn't right. Again, I'm not really looking to position the portfolio too heavy right now. But this one, I still think is now in a really interesting spot. This has been a pretty significant move, right? So here it closed at like 270 and it's already at 313. It's a big, that is a big move. And it doesn't look like it's slowing down too much. The volume is paring down slightly, but it's still well above average. So there's a lot of interest in Spotify here. So again, you can do that kind of, well, what you will with it. Couple notes, it does have earnings coming up on the 23rd. The other thing I really like about it right now is volatility is high. So even if you didn't want to necessarily use long premium strategies here, you can use short premium strategies and get paid pretty handsomely for it because we're starting to see elevated volatility in here, especially on a IVP basis, 94%, IV ranks 80. But again, you all know my go-to is IVP versus IVR. So that does look good. And then the other trade that I am still in winding down is Lululemon. Funny enough, for Lulu, we talked about this with the pro community not too long ago, and it looked good to me. And actually, we talked about a specific plan in there, which was I didn't necessarily know if it would have this kind of downside velocity. So when I was looking at trading it, I wanted to see downside weakness, but then I was just going to sell premium. And that's exactly what I did. And that's also easier for me in a bunch of different ways from, again, a timing perspective, because I don't need to allow it enough time to get the size move that I want to make the long premium strategy worth it. Again, because I have an artificial kind of time hack that I'm backwards planning off of. Obviously, I'll keep trading even like through when we're traveling, but I look to set up the portfolio to be in a healthy spot so that if for whatever reason I don't feel like it or I don't have service or whatever, that it's no worries, it's no problem. But yeah, this one has been working out well. And it also was kind of a good add for the short deltas. This is the other thing, that continuations and stuff like this are really interesting, especially because it fell down below this most recent low and it's essentially posting new. It hasn't quite touched the absolute low on the candle, but the low close, it's already below that. The other thing I see here, again, it has earnings coming up on the 30th, but what I also could see happening in here is if we move this out to like a year, we can see that it's flirting not quite with year lows, and it's given up, over a year of gains, which is wild. But it doesn't look like it's dying yet. It looks like it had a rough earnings release and the market's digesting and renormalized pricing here. But this is one of those kind of few products that I actually think you can trade both directions very reasonably. What I mean by that is, while it's in a downtrend, that's exactly what I would be doing, is trading the downtrend as I am. But then again, time probably won't permit it for me. But if I see this start to base heavily, then that becomes absolute reasonable candidate for short premium, long strategies or neutral strategies until we get closer to earnings and until it essentially becomes time for either earnings play itself or exiting the trade before earnings. But this is in a longer term uptrend. It still has strength. It's been knocked down by a bad earnings, but even on a 6-month daily, it's still uptrending despite this pretty massive sell-off from what did it close at here? 478 down at 356. It's a big move. And it's still trending down. Again, this isn't something that I would jump into before I see some solid basing for anything to the long side, but this is a product I personally would have no problems trading both sides on. It would just need to display the subsequent strength to make it worthwhile. Big A says, did you cover VIX already? Was that the earthquake mostly or the flu? I don't think so. I think right now the market's just a little skittish. And for a bunch of different reasons. I still have my long VXX trade on. I actually took some of it down today. And I think this past week, there's been a lot of information coming into the market. So I think a lot of what we saw has to do with all of the Fed messaging this past week. It's tough because Powell has been very steady as a drumbeat, but there's other people in this system. There's other people that can have other opinions that he may or may not agree with, or they may not align on. So because of all of that, it doesn't surprise me to see volatility starting to tick up and to bake in some of this potential risk, because I already told you guys this. If we come into the circumstance where the Fed chooses to not lower rates, or even worse, if they even start getting further into discussing raising rates, the market is going to lose its shit. It's not going to like that at all. And we can see, I already reviewed this earlier, but it's worth taking another look at because I haven't looked at it yet. So the probability of a hike in 1 May has come down. The probability of ease has cratered into essentially nothing. It used to be up almost 20%. So the probability of a hike in June is now gone. The probability of a hike in July is gone. So it looks like the probability of a hike has now essentially been removed from the equation, which is good, because that was going to be pretty damn problematic, I think. But look at this. In June now, it's leaning more to no change. This is the first time where out in June, we see a big change in market disposition towards this. This is a giant deal because the Fed was originally, the earliest prospect for a cut was literally back in May. And then we saw in June, it was overwhelmingly going to be a cut. Now it's just getting to the point where it literally might be nothing. Then if we go out to July, this used to be slam dunk probability of an ease. Now it's still overwhelming probability of an ease, but 30% probability of no change is not nothing. That is absolutely enough to start getting the market to reconsider the way that we're pricing things. Remember, markets are discounting mechanisms. They're looking out 6 to 9 months and discounting earnings from there. So if we do fall into this persistent inflation environment longer still, that can be a massive problem. And as we look at non-farm payrolls today and unemployment came in on target. But if we take a look at non-farm payrolls, it's kind of a different study. Let me go back here. I'm trying to see if there's like a don't care. Here we go. So what I'm doing right now is just seeing the expansion in the different employment. They like to split it out by all these different statistics. And honestly, like I really don't pay much attention if there's a massive disparity between 16 and 18-year-olds. I'm sure you could look into that for sure, but I don't really care about it. What I typically care about is these higher level summaries that let me see what the labor force is looking like. This is an important metric for people that are not participating in the labor force. We want this low, and we want this continuing to go down. So today, non-farm payrolls, they were expected to be 214,000. It came in at 303,000. So that's a massive change today. And the other thing that came out today that was really interesting was consumer credit. And that came in low, which funny enough, I was actually just showing you guys all of this stuff. So believe it or not, you are already ahead of most people, because I think that they haven't fully digested this information just yet. And again, this is a really important metric to see this figure coming down a bit. IR Too Bad says full-time jobs are dropping. Yeah, I haven't looked though in terms of the quality of the full-time jobs. If you know more about that than I do right now, that would be a really interesting Let me see. I don't want season. Here's unemployment. So unemployment's going down. Yeah, so unemployment's going down across. Oh, there was full-time. Yeah, so full-time is going down. So this is good. So I'm actually not sure what you're referring to, Ken, because this would tell me that full-time unemployment is contracting, not expanding. So maybe you're thinking about like a specific industry or something. That absolutely could be the case. There's a ton of industries right now that are under fire, so I could see that. But I think writ large, this data is suggesting a different picture, actually. Yeah. Even part-time's expanding a bit, but that also makes sense kind of with, this is a seasonal figure, so we see this move quite a lot. Paul says one of the next inflation-related numbers coming out. I guess that really depends on what you consider inflation numbers, because next week in the 10th, we have CPI and core and non, which that absolutely will be a direct impact on inflation. And then the FOMC meeting minutes are also coming out next week. That is another direct impact on inflation. Then we have PPI, jobless claims next week. We have some more Fed speakers. So, I mean, there's a ton of inflation related metrics coming out, but we just had like the last round of inflation specific numbers come out not too long ago. So I think we'll have a couple cycles before we see the next. I think the next big thing that we're going to walk into is going to be the 1 May rate. This is, again, the same thing I'll remind you guys of. I don't view this as the rate decision itself that looks to be generally agreed by the market, which is all great, but it's the messaging around this that's going to be way more important. So that's actually why the meeting minutes that come out this coming week, again, on the 10th, that's like a must read. I absolutely am going to hop in there and read all the way through that, because especially after this past week, with the number of Fed speakers we had come up that were all over the map, I can't really tell what their angle is. Like if they want their 5 minutes of fame, if like, I don't fully understand the picture, because there's such a discrepancy between some of the messaging. It's crazy. And I don't fully understand how that plays out, because Powell typically says that all of the members are generally aligned. And I could see that to a degree, but obviously in the way that they're voting. But when they're talking about it, it's like, shit, dude, like this is actually a pretty different message, like pretty massively different message. I don't fully understand what the angle is for some of these folks, especially with the stuff that they're talking about. Again, it's one of those things that I think there's a little more political component to it than we might be abreast of. At least that's what I think about, because otherwise it makes no sense to have some of these Fed speakers popping out the way that they are. But nonetheless, I think it's an important thing to keep in mind as the meeting minutes come out, because you're going to get to see a lot of those conversation points in the meeting minutes. So that's that. All right, you guys, that wraps me up. Got a dinner with my lovely wife, so we're going to go do that. I will see the Outlier Pro members on Sunday for the market prep session, and then I'll see everybody else in the Discord, and then on the Monday Night Live. Have a great weekend. See you guys later.